What's up, friends? Welcome to the stream. Live show, the Rocket Scooter. Coming to you live every day, showing you how these markets work. Trade them like a madman. All right, friends. Hit that like button, friends. Let's go, let's go, let's go. Good morning. Just joined the program, going through the material. Very cool stuff. Hey, Grant, welcome to the team. All right. Ooh, baby. Let's time my microphone here. Hey, what's up? Welcome, welcome. Going through the material. If I could only go back in time, I go through the material for the first time. Remembering what it was like the first time I realized that there's so much more to the market that I never knew. Hope you're enjoying yourself. Learning about liquidity, volatility, like the things that actually move the market. And welcome all new teammates to the team. Ready to kill it today. Let's take a look at the pre-market stuff. Make all my little social media posts here. Let's read the news this morning. Welcome, everybody. Where's my stuff? Here we go. All right. Read the news. Morning routine every day. Make sure you check the overnight stuff. Wells Fargo expects the Fed to start cutting rates in June versus May, expected earlier. We are... Looks good. It's a good sign. I'll turn that on. Nothing important there. Check my financial juice. Check the calendar. See, we have a very light day today. This is a very light day. I love light days because it's going to be very easy to read. Looks like we are gapping down slightly. The resiliences are negative out the door. So I think we might have like a resistance kind of day today. I retrace a little bit of the CPI from yesterday. Let's get our charts marked up really quick. All right, so get ready for the morning prep. Welcome everybody. All right, back up our chart today. Let's take a look at a couple of our things we like to put on here. Welcome guys, everybody, welcome. What's up F2? All right, so we have a 5233.75. Oh, I need to mark up my new chart here. Okay. Horizontal array. Let's go here. Let's go down. Get my glasses here. Serious mode. Serious business time. I have multiple pairs of glasses. Some are my backups. You are my backup. Get over there where you belong. You're the good one. All right. Woo. See, I can see the light. Oh, no problem about dark pools. Yeah, it's useful information. Yeah, we talked about that yesterday. It's just hard to be actionable sometimes. Definitely useful though. Any piece of information about positional data is useful. And the one thing about that is you don't know the position. You don't know if somebody's getting in, getting out. The person that ordered with the dark pool, you wouldn't know if they're trying to get in or get out. It would look the same in the report. That's the one thing that is missing. But that's pretty much all time in sales. You don't know if somebody's getting in or getting out of the position against the house. Okay, so let's make a clone here. That's just I'm just gonna clone some of my lines from earlier. 216.25. Be trading ES futures today. Oh, why am I on the micros chart? Oi. There we go. I was wondering where everything was. Okay, we get this 54. 26.5. Setting up for our illiquidity pivots here. Just to have them ready in case we do fall. I think we're going to sell today, but I'm not going to speculate on that. Don't think that fall in a bear market. I'm not. I just have a gut feeling. But I'm not going to act on that. We are gapping down. In this in SPY. You can probably pull back some of that CPI run. But so far, so good. Probably up before down if it's whatever, but I don't think we're going to sell off today easily. We are gapping down into resistance to be positive. So as we get this rolling forward, let's see what we get here. The UI doesn't look very user friendly at first. I've got multiple charts on my screen. Ready? Watch this. This is your UI. This is all you need to trade with right here. This is it. One tool at the bottom, one tool to the right. But what I do is I have multiple charts up to make it look a little extra. I'm just adding a few things to my chart. Futures. But I promise you this, after about maybe like a couple of days, it'll snap right in. There's a couple of rules we follow. Let me show you the easy rules here. 3 major indicators: DD, resilience, and the liquidity map. Just quickly. Liquidity map, I'm gonna have a series of letter codes print up at the top. It's gonna help me find out where the flow is going. Just like yesterday's BLU, we traded straight up off of that. Here's that BLU trade. Arrows pointing up from the blue line, So basically what you do, Maz, is this right here shows you where the pivot points are. It's like drawing arrows on the chart. And this uses options to find out where that flow is going to be. Whole different ball game we do here. So that, this is predicting if the gap's going to fill or not. This is predicting if this little bull zone area is going to support or not. Great. Armar, your DD number is showing 5207. Yeah, Omar, roll over, and you guys make sure when you roll over your contracts, roll over on the CME date. You go to the CME website, they'll tell you. All right, everybody, hit that like button on the stream. We love you guys. Please, please, please. Real quick. Is there a triple V this week? There should be on the Tuesday or third Wednesday, which is yesterday. Let me double check this really quick. VIX expiration calendar. You guys are so smart for remembering these things. Are better than me. March 20th. So we have one more week on this one. So it'll be next Tuesday. So map pop up the open. Yeah, Sean, it absolutely does. So after the open, what happens is the calculation runs the moment options start trading, and we run the calculation within 30 seconds or so. All the liquidity maps should pop up. Great question. So I have my S&P and Nasdaq resiliences here. It looks like we are slated to probably trade a little higher or maybe at par. We're going to open pretty much flat across the market now. Can you explain where you got the yellow and blue line? Oh, so these are from our overnight calculations. So we have other pivots we do overnight versus pivots we do in the morning. In the overnight, we run a different kind of dynamic model in the options world to find out where pivots are overnight as well. It's hedge pressure and monthly hedge pressure estimates. So overnight we run this and it lasts overnight. Morning we run the actual and that replaces the overnights. So I keep these here because what we've been finding out is that the overnight balance points are still actually pivots, just to keep tabs on them. So neat enough, this is something that a newer thing that we're starting to study. So I'm kind of putting it on the chart just so I can pay attention to it. These things are the estimates last night. And they are very, very, very solid, even pre-market. Here's NASDAQs right here. The overnight pivots are golden. They create high volume pivots. The estimate is trying to predict what the open interest is before Opera prints it out. We do it at 5 o'clock in the evening. Or sorry, 5:45 in the evening. And it lasts all night. And look at NASDAQ pivoting off of those two lines. So in the mornings, we thought, okay, that's neat to know that overnight there's active support and resistance. In the mornings, we found during the morning session, they still pivot. So I'm trying to see if we can find any probabilities with them. So it looks like we are gapping up, trading up. How does SPY price correlate to the the S&P futures price, it's about a 10-to-1 ratio, give or take, and it definitely moves around a little bit, but about 10-ish to 1. Let me reopen my charts. Oh, I know what I did. Let me load this up. Okay. Give me 1 second. Let me reload my layout here. Oh, let's get here, close this down. Sorry about that, guys. Hold up. Oh, you know what I did? I saved over my old layout. Okay, let me have to remake this. Hold on. Oof. All right, do this really quick. SPY. Those are inactive charts. Okay, we are trading in the middle. Resilience is positive. Okay, we're gonna wait on this and let it simmer. This is mean reversion long up. So mean reversions are interesting. So they like to trade in the middle. We are losing bull zone, so it might be a short setup. In the middle. Bottom bull zone's likely to bounce. No, it's actually losing. Okay, let's load up another chart. My VIX here. I think it is that little short setup I was talking about. Let me give it a second. Resilience is positive though on S&P, negative on Nasdaq. So Nasdaq's going to start pulling everything down a little tiny bit, but usually the S&P wins this fight. Let me get set up here. Those other charts are left over from another instance. All right, let's see. We are mean reversion. So mean reversion is going to point to the middle. This is likely downward pressure. Nasdaq is falling pretty quick at the open. The S&P's resilience being negative. S&P is going to fight in here probably. This half gap is going to likely be resistance. So I might actually take a short from here to the middle. See if it does anything. VIX is looking clean. QQQ. So IWM is hedge break to the upside. QQQ is hedge break to the downside. We have competing signals here. QQQ breaking hedge pressure is likely downside move here. So be very careful on this. Yeah, let's take it. Whatever. We're going to trade in here on 2 spots. I don't normally short. We open here. Probability is we are closing here. So with negative resilience, this is a liquidity pocket. Be careful on this one. It's gonna be very tight. So my stop is here. I don't normally short, but let's go ahead and take it. My stop is like essentially a bull zone break a stop. So I'm gonna actually -1 there, -1 there. And we're gonna trade it lower. All right. The overnight, yeah, the overnight moves pivot in the daytime. We've noticed this. It's something that's interesting. We don't normally didn't normally expect something like that. Out the door, Russell is moving though. You're seeing a little bit of rotation. So Russell moving to the upside today. Nasdaq moving to the downside. The S&P trying to fight at this old red line that it had. I think we're likely losing some steam here. So just looking at the Nasdaq, how people are rotating out of the Nasdaq to rotate into the Russell. That's just sign of sector rotation. The index divergence light. Resiliences are now both negative, which is good. We're at the bottom of the box. The box itself is resistance. This is going to go down pretty quick. It's just happened. All right. Watch out on this one. Okay. Let's see. IWM is about to hit its own resistance at 206. So IWM is here to there. So I think in general, let me guys show you the read. Okay. So VIX is in a bullish liquidity map. So VIX is likely to go up. So volatility is likely to increase. That's one thing to take note of. Number 2 is the DD ratio is really, really, really high. So you have a 96% probability that you bounce a bull zone, and we didn't. We fell through it. So this is one of those rare cases that whenever you lose bull zone, it's a 4%. Usually the least probable thing is a very severe thing. So this can trick a lot of people and squeeze a lot of people on the long side. As people roll out, they can get pressed lower. So when the rare thing happens, just keep in mind, taking notes, the rare thing is usually severe. We are irrational, the hedge pressure break to the downside here. I am looking for maybe us to get down to about 26, give or take. This one here. Now again, that's if Nasdaq doesn't survive. Negative resilience, as we're fighting this, it looks like it wants to come down. So this is how, let me show you the 3 different indicators we use to determine this. Negative resilience means below this redistribution zone in SPY. The midpoint is resistance and the bottom of the box is resistance. So both of these areas can act as resistance right here, here and here. That number is negative, and it is. Number 2, this number called DD ratio right here. You're expected to bounce at the bull zone. And we fell right through it. So when we fell right through it, that's a big deal. Usually rare things, and the probability of the bounce is actually 96%. So this is a 4% chance we break. Usually those smaller odds squeeze a lot of people. So I usually sometimes can take that bet. Bull zones very much support all the time. We broke it right at the open. It's pretty scary. DD is extremely positive. Maybe DD float. That's exactly what I'm looking for. So while DD is positive, it does tell me it's going to make one more attempt up, which is exactly what you're saying. And I agree. From here, it's going to try to push up about 3 points. That's why I put my stop about 3 points higher. You're correct. So I'm going to take a pretty aggressive short here. I'm going to hit it really hard right here and stop really tight. It's a really tight move. I know exactly what I'm doing. So I'm not hitting it, I'd say mildly hard, mildly hard. You guys see me rarely when I short out the door. All right. Nothing going on the news today. Nothing excitable really to talk about. Let's take a look at some of the stocks and let's run the scanner really quick. Yeah, so basically if you guys are curious about the strategy, that's basically it. I have a series of indicators. There's only 3 of them. None of them are using charting. This is using an aggregate of the stocks filling their gaps or not. So we have just different modes. If this number is greater than or less than 0, I act. If this number is greater than or less than half, I act. And then the liquidity map's pointing the direction I'm looking to trade. Yeah, so NASDAQ and Russell having divergence. It's a really big deal, right? So you can see that people are rolling out of NASDAQ, rolling out of SPY, rolling out of tech stocks, and they're rolling into Russell. It's typical of rotation, which means it's not going to crash, I don't think, but it is going to likely come down a little tiny bit. Let's watch the earnings today, see if there's anything going on. Aftermarket, just to make sure I have all my things checked. Okay, that looks good. Quick read on the commitment of traders report. This is just from last week. We always read this, but letting you guys know the market's still liquid. Kind of too liquid to crash scenario. I'm looking for that negative resilience right here. As it's trying to fight positive, it's fighting all over the place. But a little choppy. It's right on the edge. That negative resilience resisting the box falling to the liquidity pocket. A liquidity pocket is the middle of a bull and bear zone. That's a pretty quick trade from here to the middle. I'm shorting right into it. Oh shit, there we go. Here I am staring off stream while we're moving. There's a quickie little 500 bucks. Look at markets moving to liquidity pocket. I like it. I'll take the $600 gain. Always trade to the middle of liquidity pockets. That's it. Let the market bounce and try to do its thing. Remember, it wants to try to at least tap that bull zone. We'll give it another shot. So that was good. Another gain. Let me eat my breakfast burrito. Correct. A little wine. You nailed it. Illiquidity pivot. So, dude, I got out right at the perfect time. And I usually look for the exhaustion candles to close out, though. Look at you, Lee, being on top of everything. Okay. Anytime I see an exhaustion candle into a pivot, which is very simple, guys. Whenever you see a large candle with a high volume spike into something you know is a pivot, always close on that candle. Trade it again. Now, if I wanted to short, I could short one more time. In a better spot. I get 4 points I missed. Do I do stocks? Tesla? Yeah, we do stocks. Liquidity maps work on everything that has options. So let me show you Tesla. Tesla is bearish today, as it shows on the liquidity map. So essentially what this is doing is just showing me on the chart where pivots will be. Doesn't mean that it has to go that direction. It just means that's where the flow direction is based on degrees. An example is, you see how Tesla right here, the diamond is the open price. Yellow is resistance. It's going to have a hard time breaking through yellow. And here's that diamond. Hit that yellow and it's resisting. Do you see how that works, Maz? Pretty simple. Breaking through these hedge pressures is roughly about 25% chance that they break. 75% chance they resist. That's actual statistics. And that's on SPY, but we use that for everything. So as it's breaking through, the more probable thing is happening. Pretty cool, right? And these are printed at exactly 9:30 in the morning and they do not change. These don't change all day. If you guys want to check out the platform, let me give you a link really quick. We made our entire trading platform just 35 bucks a month for 3 months. You guys can check it out for all the tools. And that's like a huge discount. It's normally like 200 bucks. So for 3 months, you guys can come join, learn all the stuff. And I'll give you a hint. If you did sign up and use the tools, and again, our platform, we're developers in the TradingView library. We actually included TradingView's charts in this. So you can use all your traditional technical analysis and our tools are all automated here. Check it out. You can watch the videos on it, see how it works. How long average takes to learn this? I don't know. Community folks here. You guys let me know. Y'all been here for a while. How long did it take you guys to learn this? Don't let me give an answer. It's pretty quick, I would say. To get proficient at trading takes a while, but to learn this, I don't know. Yeah, teach a lot from the indicators? Absolutely. Everyone here, by the way, smash that like button, everybody. Check out the extended trial, like I said, for 35 bucks, you can get there and learn everything we teach, watch all the videos and just check it out. All right, so I also made like, how much did I make last night? I think I made $500 last night and $600 today. So I'm up another 11% of Robin's Cup. I should be up at like 63, 64% on this leaderboard now. So it should put me in 5th place still, or stay in 5th place still. As long as no one else has come down, like maybe I'm 4th. How many weeks did it take you guys to really learn everything? If everyone's here, can y'all maybe help out, Mass? Very simple. Okay. So if you were to go buy, and this is it, you're a trader. I'll teach you guys, I'll teach you in 2 minutes. You're a trader. Say that you longed 10,000 shares of Apple, okay? The market order, because you just fat fingered it. Typically there's not really, you know, the level 2 has bid and ask, right? Bid and ask. Typically there's not a trader on the other side of that. It's a pretty big order. So on the other side of your trade is a bank, and we call them market makers. And what they're going to do is they're going to short, I'll put a negative sign, 10,000 shares to you as well. You follow so far? So when you buy, you immediately get filled because they sell to you, and then they're looking for somebody to sell to them. They're out there shopping around for a seller. They're like, okay, we need seller. He bought, let's find a seller for him. In the meantime, they have a short risk in the market, but they don't want short risk in the market. So to balance it out, they're going to buy call options. And let's just pretend there's no delta hedging. They're going to buy call options the way to delta, or at maximum, they're going to buy 1 call per 100 shares. So they'll buy 100 call options. So far, so good. So you're long. This person is neutral. They're short 10,000, they're long 10,000. As long as they shorted at the same strike as the option expires, either way, their trade is frozen. No more gain, no more loss. But typically they'll buy according to delta. We'll get to that later. So trader, market maker, and you. So one more trade takes place, which is the market maker of the options world, who wrote the options, the one that sold the calls. They sold 100 calls. So in this particular sense, you wanted to buy shares of Apple, and you got 2 banks fighting against each other so that you can have your trade. Anytime a call, say that a call expires here, goes in the money, this person is forced, keyword forced to long at a rate of delta, which is 10 shares for every 0.1 delta. They're forced to long 10 shares for every 0.1 delta. Anytime price goes below the call, they're going to force sell at a rate, again, 10 shares per 0.1 delta. So since this person is forced to long or short to remain neutral, we're exploiting that one principle. Our algorithm watches for trades like this and categorizes all of them into market maker trades or not. So in every single trade that takes place in the options world, our algorithm will pluck from it, market maker, market maker, market maker. It looks for that. And then it sums them all up and it looks for all of the different parts of that triangle that I drew. Let's make this bigger and show you. It's a whole different way to trade. The exploit that we have on the market is completely different than what you're used to. What's a bull zone? It's here. This is called a bull zone. You'll see right here, bull zone. It's where there are more people long the shares of the underlying against the market maker than there are short to the market maker. So when you actually isolate all those market maker options, these are actual traders that are more long than short against the house. So imagine this is a casino, you're betting against them. These are people that are more short against the market maker. We call it a bear zone. So we actually can split the market into 2 distinct zones. People are long against the house, short against the house, and it's all derived from options. The second thing you'll see are these numbers called hedge pressure, and hedge pressure being on here somewhere. This is between the trader and the market maker. Hedge pressure is between the market maker and the market maker of the options. So the other part of the triangle. You bought the shares against the bank bought the options against the option sellers. These are the people that are forced to long and short according to delta, and this right here is the maximum gamma exposure of market makers who sold options to other market makers. Oh, you can't see because my face is in the way. Oh well. You don't see what I said. Okay. Long story short. People are forced to buy above here. People are forced to sell below here. Forced to buy above here. Forced to sell below here. These are based on weekly options. These are based on monthly options. So the different techniques, it's really interesting, but what it does is it creates pressures between the market. Inside of the middle, this is called a liquidity pocket right here. You have your bulls up here who are all long. You have your bears down here that are all short in abundance. So the middle is actually balanced. Why did I short this to oblivion to crash out? Well, because dealers love to keep prices in the middle whenever you're in this kind of mean reversion liquidity pocket sort of thing. Most of our traders will not trade from bull side to bear side and keep going. It is 4% chance to break that, and 4% of 4% chance to break that. So the probability, believe it or not, according to our back test in S&P, is that if you open in a bull zone, you will close in a bull zone 96% of the time. That is no joke. Actually, sorry, 96.6% of the time. To break bull zone, to break each zone is 4%, so about 3.4%. So the idea is already rare enough to come here. It's going to be ultra rare to go there. So to break this is another 3.4 of 3.4%. Less than 1%. I'm not going to do that math. So I got in the short. I'm betting on the market kind of like being stable inside of there. You notice how once we hit that bear pocket, it's starting to kind of collapse in on itself. Pretty neat. So that's how our technology works. All of these things are derived from options. So if you guys want to do a fun thing, throw me a ticker. Why not long here? Because I'm not over trading. I made my one trade. I usually make one trade a day that's really solid and easy to predict. I don't like what I see, and everything just kind of looks a little off. So do me a favor, guys. Throw me some tickers, and I'll start running a liquidity map on some tickers and kind of show you what it does. Now, again, there's some other things and considerations that we take. We look at volatility and irrational signs in the market to make sure that those probabilities are still good. Side note, that 96% requires all of these lights to be red and yellow. So this is kind of like, if you think about it, it's kind of like stoplight in your car. Green means go, yellow means caution, red means. So when any of these lights are red, throw out every technical indicator you have. If you want to learn one thing from me right now, if you use any technical indicator to trade with, any indicator period, including our own, when these lights are red, they are no longer going to work as good as they did before. You have irrational things going on in the market. These things called hedge breaks are causing what's called a delta squeeze, gamma squeeze. People are getting squeezed out of positions against their will. So the market gets surprised when these lights are red, these two right here. Things are irrational. And so somebody says, why didn't you long here? It's because they're irrational, right? Okay, so Sean says AFRM. Okay, let's actually look at this. If there's options for it, we will have a liquidity map for it. So AFRM, B, S, and D is the code. Blue is resistance from the open. So here's the open. There's blue. Blue is resistance from the open. You see how cool that is? Doesn't mean it has to do this, but that's where the flow balances out. These are all those market makers that are forced to long or short. They're more short than long down here on weekly options, and this is monthly options. So you see how it looks exactly like this kind of, and it looks exactly like that. You can draw the red line. So as far as additional guidance, whenever you're layering up your probabilities and like your pivots and stuff, whatever your other indicators are telling you, this is a layer built just in options. You don't even have to know anything about options. We draw the pivots on the actual stock itself, and it affects the buying and selling of the stock. So it's predicting order flow and high volume. Case in point, every time you touch hedge pressure is a predictable high volume pivot. Remember, gamma maximum is maximum gamma squeeze. Maximum delta. Try that again. Maximum gamma is maximum delta hedging, which means maximum order flow. So you'll see a volume spike every time you touch hedge pressure. It's a very cool thing. It's predictable high volume pivot. That's it. So what did somebody else say? Apple. Let's run that real quick. Apple is in this kind of mean reverting setup where it's pressing to the middle. There's really no actionability on Apple. There's no pivots nearby. So I'd look at Apple, I wouldn't trade it. So I wake up today and I say, well, you know, obviously it's going to resist there, or it's maybe going to support there. We're trading in the middle. Aha, my risk management's kicking in. No way, Jose. Apple, sit out. I see Apple and I go, there's nothing to bounce off of in here. It's very wide and it's very unknown. It can go either way. So don't touch it. So then I can wake up and say, I'll sit out today and not do anything. You'll see how that works. So you can use this to avoid trades too. Throw me some other ones. Can you see the MSTR shorts getting squeezed? Yeah. So anytime hedge pressure breaks, you can see short squeezes. If there's options for it, you should have something. The TR. I have liquidity map on there twice. Let's put it on there once. Okay. So I made like $600 profit today. I don't know if you guys saw that. $500 or $600. How much was it? Maybe $600 profit. Okay. Here, liquidity map. This is a tricky one since you're learning. There is no actionability right here today. So if this were to fall, there is support between the yellow and blue. So there is support here. If I were to buy this, I wouldn't buy anywhere, and I would buy the dip right here with the short, with the stop very close to that as well. These are very far away. I mean, this is like massively large, which is probably due to something moving that quick. But this is not tradable. Again, it's really far from any pivots that I trade against. These are my pivots I trade off of. So again, not tradable. You guys are going to see there's a pattern. Why was Apple not tradable? Why was MSCR not tradable? Why are these things not tradable? There's no actionable pivots. And when you look at the entire S&P, the S&P is kind of in that balanced setup. There's nothing really aimed to pivot, and you can see that reflected in the entire index, which is the coolest part about what we do. Why is the S&P itself kind of balanced between a flat spot? Well, because nothing here is slated to move. This is unpredictable and choppy. Apple unpredictable and choppy. Do you guys see how that works? So when all the other stocks aren't really having momentum, it's not going to be a surprise that your index is balanced. And that's kind of a neat phenomenon. If the index is balanced, you're not going to find a lot of momentum plays out there in the market. Microsoft, right? So you guys, again, if y'all like what you see, feel free to subscribe to the stream while you're here. Number one, check that out. Number two is we have two really cool things going on here. You can get all these tools for 35 bucks a month. Check it out for 3 months. We'll have a little trial there. You can watch all the videos, play with it. Stack these things on top of your normal indicators. You won't be sorry. This is using positions to give you additional insight in the market. The indicator is just looking at price action. This is looking at people's actual positions, big firms, and where they're invested. That's a brand new thing that we created. Okay, Microsoft. This is a good one. So Microsoft is fighting against a hedge break right now. So anytime you break through hedge pressure like this, let me show you what Microsoft was when it opened. Now, this is a cool one to talk about. What happens when the price just blasts through the support it's supposed to hang out at? And that does happen sometime. Microsoft started off as what's called a BLD right here. It opened and the orange is expected to support 75% of the time. Well, it blasted through it. So now we shifted to this red one right here. So if it breaks, a smaller probability it can fall to blue, which is what happened here. So now in this particular case, both the legs are represented, but the lower probability move took place. And again, stock markets are random. So, you know, it was a 75% chance it bounces there, 25% chance it breaks through, and then it broke through, and then this is that leg that took place there. So we expected that. But when the index gave us signs that things are a little iffy, you may not want to choose to buy the stocks. You can use the index level to kind of give you the idea that, oh, the market's acting weird. And that's kind of what we do. Thoughts on a long here? No. Absolutely not. Not for me. 0% chance I will long this today. The first thing I said, what everybody type in chat real quick, was the first thing I said even before the market opened. What did I feel like things were going to do today? I very rarely say this. I said today market's likely to sell off. No longs. Thoughts and prayers. Let's go. We're good. What do you think is going long in ES now? Touches bears up? No. That's not an entry point. This is not, that is never an entry point off the top of a bear zone from the, no, never. Never. Not only that, we broke through the bear zone, and it's a very small probability that we go through here, but we're irrational, so those probabilities don't really mean anything anymore. If we weren't irrational and we open in the middle, sure, I can buy off a bear zone to trade to the middle. But again, irrational market. I will still steer clear of buying anything here today. I wouldn't touch anything myself. I'm done. I'm done trading. Done. The rare thing happened, and then when I told you, the rare thing tends to be the severe outcome. Case in point, the lottery, right? How many times you guys won the lottery? Probably 0. But when you do win the lottery, it's fucking huge, right? How many times, if you buy 100 penny stocks and one of them blasts off, the winner from that one usually outpaces the loser from the other 99. Again, the rarest outcome is typically the most severe outcome. So when something rare happens, I don't bet against it because the severity is there. You got to keep that in mind. That's how you avoid blowing up your account in this world of trading, guys. This is incredible. Oh, Grant, thank you. I love you. Yeah, feel free to check us out. Like I said, we do webinars every day. We actually have this thing going on in our lifetime program. I'll let you guys know one more time. We have a special webinar going on this week for lifetime members as well. You can buy the platform, and again, the whole trading platform you can buy outright instead of paying a subscription. And we do, it's like normally 4,000. We're doing this thing where it's like 2,400. We closed that out on Sunday, but since you guys are just joining it for the Robbins Cup, I'm sure come and check it out. You guys can take advantage of this. If you want to, I'll open it up for one more day. You guys just want to buy our trading platform and utilize it. You can actually check this out too, or just pay $35 a month. So this is a link for that if you guys want to. And you get all the tools, all the indicators and stuff to go with it. And then, or $35 a month right here, this one. And like I said, if you guys use technical indicators, totally cool. But a lot of times you try to stack indicators on top of indicators when you trade. Right? You might have like 40 different indicators. Let me play a game and ask you guys a question. Let's play a game and let's call it... I'm just gonna pick some stuff. We're gonna play a game. It's gonna be called, does my charts look like this? Everybody. The game. The game is called, does my chart, do my charts look like this? Everyone type really quick in chat. Do your charts look like this? It's not bad if they do. Let's play the game. Like, do my charts look like this, everyone? Kind of. If you weren't here before, a lot of people won't see us. I think a lot of people don't trade indicators anymore. Everything, I'll just add a bunch of random stuff on my charts. Yeah, well, you guys don't, because y'all are different. Different breed of folks. Yeah, I expect anybody here, yeah, kind of, which is okay. There's nothing wrong with technical analysis. Nothing wrong at all. But the difference between this and what we do, and this in itself, every one of these indicators I've added, a bunch of random stuff, they're good. They're just not that different from each other, despite the way they look different. Every one of these indicators just takes price array data. It just takes the candle data, throws it into some equation, and then spits out an output. There's nothing magical about those equations. They're all similar-ish. They're looking at some relationship between price and itself, and then giving an output. And, you know, typically they all point down at the same time. Like, they're all pointing down at the same time. They'll all point up at the same time. And it's going to be kind of like on the shorter time frames, like the 1 minute, it's going to seem very noisy, right? You guys experience that when you trade? I'll teach you something really cool. There is no real confluence between multiple technical indicators. Don't let people sell you that idea. They call it multi-time frame confluence or whatever. It's another key word for my thing doesn't work. So here, buy a bunch more things from me and put them together, and maybe it'll work, and use it on multiple time frames, and then maybe it'll work. You don't get any additional understanding of the market beyond like a couple of indicators. You add 5 or 10, you're going to get the same read. Like, oh, this is coming down, this is coming down, this is coming down, this is coming down. They're all coming down at the same time. So which one is more actionable than the other? Which one's better than the other? And the more you add, the more complex it gets and the harder it is to use. So there's nothing bad about it, but beyond 1 or 2, you're kind of gonna have diminishing returns. Really, the only indicators I subscribe to are any ones that use volume, like VWAP. Those are all really, really good at what they do. But again, you don't need like 25 things to look at. You just need 1 or 2 really strong indicators. How many indicators do I use, you may ask? The answer is 0, price-based indicators. I don't use this stuff anymore. They use price and calculate it. So even if you are wanting confluence with technical indicator, don't use another technical indicator to do it. Don't stack them on top of each other. You're not going to get anything extra. Instead, look at it from a different angle. For instance, technical indicators look at price and volume of the underlying. Okay, that's cool. So why don't we look at the options of the underlying, completely separate world, not even related, and get information about the options world, information about the futures world, and information about the equities world, and then confluence between those 3 where people are trading 3 different things that are all tracking each other, and let's look at it that way. That's actual confluence. So our tools look at the options world to give you information. Other tools of ours look at the futures world to give you information. If you're trading the S&P, you want to look at options, futures, and the S&P itself and the stocks inside of it. All 4 of those things give you clues as to how the S&P is going to move, not the S&P with 50 different indicators of the S&P. Does this make sense, everybody? Yeah, and as Eunice says, one will work every time. And which one works every time, you'll never know. So real confluence is to look at something else. Okay, I have momentum to the downside on this VWAP. Okay, we rejected VWAP, it's coming down. Let me pile that up with something else. I'm trading S&P futures. Okay, so I want some confluence to add to my signal. Let's use Rocket Scooter. Should I buy the dip here? Or should I reject here? Okay, well, let's do confluence. 8:30, S&P futures fell below VWAP and tapped it. Most normal technical traders, we know this, is a short off of VWAP. We do this all the time. I don't anymore, but that's a very valid short. Volume weighted average price resistance. There's volume into that move. It's decent short setup. Okay. Then I come here, which is looking at the options of SPY. And these 2 things are tracking each other. As you can see on the screen, they trade pretty much exactly the same. The 2 charts are the same. So if this is losing a bull zone and this is rejecting VWAP, that's some strong confluence. 2 things are adding up. Your technical indicators are insanely stronger when you pair them up to the positions in the options world, which is telling you. And all of these things are tracking the sum of those 500 stocks in the index, right? So if you guys buy the tool set to use, stack it on top of your technicals and watch them get better. It's showing you what's going on in the market. You'll have another layer of decision making. Your noise, you might have mixed signals in the market with all these price-based indicators pointing up and down. They're all based on price. There's no different input. The inputs to our stuff are completely different. Only thing that calculates these boxes and these hedge pressures are options. This doesn't even know what the price is or care what the price is at all. It doesn't even look at it. Price isn't even a function of this indicator here. It's only options and price of the options themselves, but not price of the underlying. So it's like, I want to see how S&P is going to move. Let me look at indicators in the S&P and options in SPY and DD bands and futures, right? And we get a bigger look at the market. And that's kind of how we do confluence here. So if you want extra tools, don't go and buy like a bazillion indicators and stack them on top of each other expecting an extra edge. There's a lot of systems or algorithmic trading systems out there that are being sold that just stack like 400 indicators on top of each other, and they look complicated, and they are very complicated, but you're not getting any additional information the more price indicators you stack on top of each other. This is adding options to the mix. You're looking at S&P futures, and now you've got options information leading into that. You're trading SPY options. Maybe you're doing some 0-day puts, you YOLO degens out there. Well, let's look at some futures levels to pair into my options trade. So we put it all together for actual confluence, which is 2 dissimilar things coming together to create a thing that's greater than the sum of the parts, right? But if you add a price-based indicator on top of a price-based indicator, it's not actually confluence. They're exactly the same, minus a little bit of math change. It's just looking at price, looking at price, looking at price, looking at price. There's no additional information to that data set. And again, you know, this is coming from engineers, so this is how I think. Are market makers looking at VWAP? I think not. Absolutely not. Market makers do not look at charts at all. They don't even look at charts. Market making computers that trade this look at zero charts. They don't look at charts at all. Citadel's mainframe is not a bunch of monitors with charts on them with the computer going, what's the VWAP? Should I supply liquidity or not? What's the MACD doing? No. Order flow management is pure liquidity analysis. Where are the buyers and where are the sellers? It's all level 2 stuff. What is the... Are we across the midpoint of the Bollinger Bands? Let me see. Let me think. Absolutely not. It's just they're like directing traffic. Buyer, seller, buyer, seller, buyer, seller, let's go. It's not analyzing anything. The decisions made on the market maker level are so quick. They take place before candles even update. These things are taking place in trillionths of a second. Orders are routed all over the place based on where buyers and sellers are. And the only information they really have on that is options information being bought and sold, and stock information bought and sold, and futures information bought and sold. And they take all that buying and selling and create their own algorithms that we have no idea how that stuff works. And I don't think they're in the business of telling us how they do it. That's how they make their trillions of dollars. The market cap of some major firms out there. I also missed the dark pool talk. Oh, somebody asked if dark pools were good. And I said they're awesome, with the exception of, there's an asterisk to that they're not really actionable as much as you like them to be. Dark pool's a cool thing. It's like, if I want to get out of an order, say like right now, and you see how, by the way, the S&P is kind of floating to the middle. Check this out. And those of you that do sign up today, we have webinars usually every day. We haven't this last week because we're doing a special thing for our lifetime group, but I could do a training session today for those of you that sign up today. At the end of the day, we'll walk you through all of this in a more simple to understand thing. A dark pool is like, say I want to go out there and dump like 100,000 share order. I just want to kill it. Like I'm in a hedge fund. I want to dump it all. I don't just go to the market and sell against this really thin bid that's like 10, 20, 100. Can't dump that into it. So usually I have two ways to get out of this order. Number one is I can open at the, I'm gonna do MOO and MOC orders like at the end of the day and beginning of the day, which means you submit to the market maker pre-market or into close, and they fill you at one price, their price. But what if you don't want even the market maker to know your price and you want to get out strategically over time? You don't want anybody to know you're sneaking out of position. You don't want Wall Street to squeeze you out. So you can take that sell order and send it to a dark pool, which is a firm that takes your order over the counter, which means you trade against them, and then they use algorithms to go to the market and then like leak your order back to the market or hedge against it. So as an example, this isn't how it works, but it's an easy way to understand it. You can't dump 100,000 in the market. We can dump 100,000 to them. And since it's over the counter, eventually they have to report this to everybody. And there's a feed that watches these dark pool orders. But the time between they take the order from you and when they report, there's a time that they have that they're operating in the dark. And in that time, they might leak it out in like bits of 100, 100, 100, 100, 200, 400. They'll just drip it out and get it into the market and then report it. So in a particular way, you're dumping a bucket of water into a bathtub, and they're like squeezing out a drop at a time and trying to go unnoticed, so that the premium you pay to the dark pool, you would pay a fee to do that. You can get out at one price. That's the reason to do it. You sell the order, they'll give it. We'll buy it from you at this exact price in the middle of the day. Market makers will do that same favor for you for free at the beginning and end of the day. But what if in the middle of the day you're in a margin call and you're in a hedge fund and you need to start dumping some shit? You might not want to go throwing it to the market, because the minute you start selling big orders like that, the market's going to squeeze against you and really punish you from exiting or for exiting. So the dark pool service is there for people that want to just get out quick. And they're going to charge a fee for that, but you get a good fill in the middle of the day. And then they're going to go out there and just drip that order to the market unnoticed, sell little bits at a time. And they may even hedge your position out the door as well. But what you guys are getting in your kind of order flow or reading dark pools is you're reading it the minute it's reported. But all that juice that I mentioned is taking place at or before it's reported. If they can, they're trying to. So not necessarily is a dark pool going to do anything once you find out about it on the retail side. Their goal is to sneak it into the market without you noticing. That's how they keep from getting themselves squeezed. So when you get those reads of dark pool information, sometimes it's good, sometimes it's already taken place. And so it's hard to kind of differentiate between the two. That makes sense. Having a lifetime only class. I know it sounds unfair, but it's kind of like this, right? Some cars have crank windows. Well, they used to. Some cars have power windows. Some cars have sunroofs. You pay a little more, you get a little more. Basically it. You're not getting any additional information about what's released though. There's not some hidden thing there. What we're covering right now in lifetime is a lifetime member is expected to like be here forever. So they know everything we've done. So say that I'm creating a new indicator that's kind of in its testing phase. We're going to use our best and brightest to make sure that it works before we release it to the platform. So in lifetime right now, we're talking about an entirely new concept in these webinars that we don't just want to throw out there to the regular subscription, because somebody new will stumble in and start, oh, I joined this webinar today on the first day. Let me use this tool. And we're like, no, don't use it yet. We're going to test it for like 6 months. So like right here, it's like the idea is we're kind of covering newer things. And I'll give you a hint. I'll tell you what it is. If I did this class for everybody, 20 or 30 people will be trading with it tomorrow. And then you go out there and start, we don't even understand what it does fully, but we talk about it with the people that are here. This is called cascading red lines. It's using contango and red lines to find multiple other additional pivots. As you see, case in point, I'm just using a purple line. There's some pivoting action against this, and this is something none of you know unless you're in that webinar. It's a new idea I have, and so our lifetime group, we get together, we're talking about it, teaching about it, and then inside of that community, we kind of figure out and investigate why, and then we create the evidence behind it, then we release it to everybody. So right now, we're teaching newer conceptual stuff that is kind of like beta testing right now. We love to have you here, man. Trust me. But it's like, at the point that we're developing new tools, a new idea can't just be like, check this out, everybody, because people will come in and start using it and be like, hey, the trade didn't work. And I'm like, we haven't even back tested it yet. We don't even know if it works. This is the theory on why it works. And this is a pretty substantial one, by the way. This is about to become a new tool in this community. It's redline, but on crack. So it's pretty cool. There's an additional, when you create a red line and anchor point, you will create red lines at all other contracts at that same anchor point, at that same point in time. So the purple line was the M contracts red line that was formed, and the H contract was the front month. And you may say, what the fuck is this guy talking about? And that's exactly why we teach that just in lifetime right now, because you have to understand everything else to understand what that is. And usually the lifetime group have been here for years. They've already learned everything. They'll understand exactly what all those words meant. So it's the more complicated stuff. We want people that really like to test it, know everything else like the back of their hand. And then when we release it, then everyone gets it. Like DD Band, for instance, was actually in the lifetime community for about like almost a year before we even release it as an indicator. So just keep that in mind. And now you guys understand how strong the DD bands are. It's like one of our most powerful tools. But before we release it, we don't just create something and throw it out there. We test it and make sure those probabilities are good. And we look out for you guys, actually. You know, first class C versus business class. But you're not getting anything like majorly extra other than early access and beta test, like in advanced techniques, which is basically advanced ways to see the market. You have to already be advanced to kind of follow along anyways. So I think the fact that hedge funds are so far away from open price indicate the expectation was price is going to drop today. Possibly, or that this is the way the options were balanced and we just overshot everything because of CPI yesterday. That makes sense, Barb. Like, options don't move around a lot. They kind of do, but CPI just, broke everyone's expectations yesterday, and so we just blasted out of bounds a little bit. So it's not indication that's going to sell off, but it's indications that we did overshoot kind of where markets were kind of pricing out to be weeks before CPI. Great, that's a great question. Yeah, we're so far above, we just shot through just kind of like shot through it. Thoughts on market internals, tick, and what is that other thing you wrote? AD, advanced decline difference? I don't use them. I think they're too noisy to use. I think they don't provide any actionable information other than same thing, price is up. They tick down when price ticks down, they tick up when price ticks up. They're very noisy, and so I've never used them to trade with because they're not consistent. Let me look at the USO. Okay, but they're not terrible. It's just I want things that are highly actionable. So you can see like overbought and oversold conditions with things like that, but what is consistently overbought and consistently oversold? It's hard to say. So in trading aspect, while it's good to have like that information, okay, things are ticking down, the advanced decline difference is down, things are bearish momentum, I'd still stack it with liquidity map to kind of find out where that flow is coming from too. So they kind of need additional, if that makes sense, Sean, you would want additional layers to that analysis because they'll tick down when price ticks down, just like the MACD would, or look like other things would. So there's not like it needs confluence to really solidify like how you want to act on it, in my opinion. What's the time frame for the Zoom call today? 4 p.m. Eastern, right at market close. BLD USO resistance off a monthly hedge pressure today. It's this red line that you see right here. Hold on, I got text. So I haven't lost but one day, I think, in this account since I started doing this Robbins. Oh. I love breakfast burritos. I make like 50 of these things at a time. Like eggs, potato, cheese. And I roll them and I freeze them. Breakfast of Champions. Yeah, so I think I'm done trading for today. It's 9:30. Unless that first action will move and mean reversions come out, there's really nothing else I can take from it. Is there a possibility to convert SPY hedge pressure to ES? There is, but you get taken into account. Let me show you. Let me show you something. Yes, but let me show you. You know, in real time, that's not a static number, though, right? You know that, right? Here, like I have a thing right here. Hold on. What is this? Oh. So like I have a spreadsheet here. They're like, this is SPY and this is ES. And there's a, I don't know, stop trying to, the ratio. Okay, here's the ratio between them. Look at my screen here. The ratio, 10.13 in real time, or every 2 seconds, I think Thinkorswim updates every 2 seconds. 10.13, 10.139, 10.139.6, 10.14, right? So the fact that the ratio is never the same. ES is trading out, actually outpacing SPY. It's supposed to be 10 to 1, but ES is moving a little faster. The fact that that number never is the same, anything that you convert or draw will also move around that to that degree. So if you were to convert like hedge pressure, let's just pretend hedge pressure was here, from SPY to here, it would just be moving all day long as that ratio changes. So when you convert, the downside is that the numbers aren't static, right? So we don't do the conversion because it's harder to teach that principle. We tell people to look at one and look at the other. And so there's a couple of ways we're going to get around that. Is to like have a static conversion. And then it only updates when you're close to it. It's like as price gets close to it, maybe it can move around, but that's just for simplicity of keeping things on one chart. The things calculated in equities, you want to look at the equities chart. Things calculated in futures, we want to look at the futures chart and put them side by side. It's the easiest way to keep everything anchored. Yeah. Well, yeah, that's the thing. A static snapshot will also mean that you have to have the same reference point. And so if we used to tell people, if you want to do that, the conversion crew in our Discord, they all do that for everybody, by the way. The rule is they anchor their conversion at exactly 9:30. The moment the market opens, they do the conversion. So everybody's on the same page. Because imagine everybody referencing hedge pressure at different points in time when they convert it. It'd be a nightmare. Everyone have a different number for it. So when you convert, you need a place to convert from. So when they're calculated, like you said, F2, you nailed it. You would do it at 9:30 at the same time you do the other calcs. And then that's what you should do. And we don't do that yet because it's actually not accurate. By the time you get to hedge pressure, it's moved a little bit because of the conversion. Say that I took this 514.5 and I calculated it. And I'm just going to make up a number. Say that was there. If I took the 9:30 and calculated it, we found that by the time this gets to there, they move at different speeds. So if this were to fall and bounce there, this might bounce early. So you'll realize that the farther away that it is, the more inaccurate your conversion actually is as well, F2. That's why we didn't do that. And that's a great question. That makes sense? Because they're going to fall at different rates as well. One will fall faster than the other. So if you have it all in one chart, you'll be waiting for a bounce that'll never happen. Because in reality, when this bounces here and you did the conversion at that point in time, it's there. So realistically, you should reconvert it the moment it touches the pivot, which led to that solution that we're going to update the calculation the closer you are to it, and then not update it at all when you're farther away. So the solution is the timing, right? So the answer is like, mathematically, this is how we're going to do it. Oops, go back. It's going to be a time thing, which is kind of it was a cool solution I came up with, which I like. I think it's kind of cool. You guys tell me what you think. So it's how frequent it updates. So imagine that at a certain distance away, Let's just kind of draw 3 tiers here, here, and here. This is price. We'll just say price is here. If price is like this far away, it'll update every minute. As price is here, it'll update every 10 seconds. And as price is here, it'll update every second. Such that like when you're really far away, like right now, every minute it'll move a little bit. And on the minute update, it'll move a little bit. It's just barely moving. If price were to fall faster down in here, every 10 seconds it'll update. Closer you are. And when it's here, every update, every second. So as you're getting closer to the pivot, it's going to update more frequently. And then you're right at the pivot, it's going to update every tick. So the idea is that when you're farther away, that'll account for the inaccuracy. Instead of having to recalculate it, it just recalculate the same frequency. The farther away you are, the things really far away will just stay put. And the things like really close to it will start moving around every time the price changes. So like that's the solution I came up with to solve that issue of the tracking deviations. And I think that's the more appropriate thing, because really all you care about is what is its value when S&P is touching it. When this is close to hedge pressure, then the conversion one will update. So right now, I don't care what hedge pressure is. It's far enough away that I don't need to care. But if I stared at it like dancing up and down all day long, it's going to just be weird on my eyes. I want to look at the things that are close to it and let those move around more often. Does that make sense? Because it was, and that's like the weird thing, because one is calculating equity, one is calculating future. It's the whole thing. All right, y'all. Thanks for tuning in, man. We killed it today. Like, I think I had $1,100 total, 600 on the stream, 500, 600 something on the stream. I made like 500 last night as well. Robin's Cup leaderboard still growing, 5th place. I don't know what the place people are in now. Last update was the 11th. I made like $400 yesterday, like two $200 trades on the stream, 11 today. So probably at 15%. So I'm probably up 65%, give or take now. According to Monday's numbers, still 5th place because Ivan had 74, but maybe some people came down. Maybe CPI squeezed one of the traders. Maybe they tried to short this thing and the market squeezed them and knocked them down. So we'll see. Or maybe CPI bumped some other people up and they outpaced me. We'll hopefully see what the report says today in the update. So going up, baby. All right, I'm gonna call it a day. Love you guys. I'm gonna bail out of here. Don't forget, friends, add a little bit of positional risk analysis to your analysis tool set. You will not be disappointed, I promise. Having a different layer of reading the market is actual confluence from different inputs. You want to look at something, you know, with price action, it's okay. Indicators are okay. But by themselves, you need something else. Don't keep stacking them on top of each other, hoping for a better answer. Instead, start looking at evidence from the other side of the coin. Here's one thing that you can say. Not everyone does this. You have an advantage over other traders, seeing things that they don't even look at. So add the options stuff on top of your trading. You will not be disappointed. Liquidity maps and technical indicators go really well together. Nice natural confluence there. When I'm trading, I want as much information as possible, and that's what we made. You guys a new way to see the market, so we're glad you check this out and come join me every morning on the live stream. Again, we're running a $35 a month. Get all the tools and the platform and the community and the education, literally $35. These days in the world of inflation, that's cost of a cocktail. So 3 months, you can check it out. Link in the description below, the extended trial. We love you guys. Check it out, and we'll see you tomorrow. Thank you for coming. Thank y'all. Love y'all. Don't forget to subscribe to the stream on the way out. Click that subscribe button. Click that like button. Leave a comment, and we'll definitely catch up.